You know, when it comes to agricultural tax, one single decision can make a world of difference. And it has nothing to do with the breed of your cattle. It's all about how they're classified on paper. Today, we're diving deep, doing a full forensic examination of one of the most important choices a farmer or rancher makes. Is their livestock just inventory, or is it a depreciable business asset? That one choice, right there, sets the stage for the animal's entire accounting life. And it can massively change the tax bill.
And here's exactly why this is so critical. If you classify an animal as inventory, when you sell it, that profit gets taxed as ordinary income, and boom, it's hit with self-employment tax. But if you classify it as a depreciable asset, what the tax code calls Section 1231 property, well, that's a whole different ballgame. The gain can get those much lower capital gains rates, and this is huge. It is not subject to self-employment tax. We are literally talking about a difference of thousands of dollars on a single animal.
So to get this right, we have to go straight to the source, right? The Internal Revenue Code itself. Our investigation is going to zero in on three key sections. We'll kick things off with Section 1231, which is what defines business property. Then we're going to dig into Section 471, which covers inventory. And finally, we are going to untangle Section 1245, which deals with that tricky concept of depreciation recapture. This is a real deep dive, so let's get into it.
Here's our game plan. We're going to break this down into 5 parts. First, the court choice itself. Then, we'll dissect the all-important rules on intent and holding periods. After that, we'll compare the 2 accounting paths, look at what happens when the animal is sold, and finally, we'll wrap up with the key forensic takeaways you absolutely need to know.
Okay, so it all, and I mean everything, starts with one fundamental question. What is the main reason you're holding this animal? Is it primarily for sale to your customers, or are you holding it for a specific business purpose, like breeding, draft, or dairy? That one decision, right at the start, determines the entire chain of tax events that follow. The holy grail for a lot of producers is getting their livestock classified as Section 1231 property. The tax code literally carves out a special place for this. If an animal is held for one of 4 specific purposes, that's draft, breeding, dairy, or sporting, it can be treated as a business asset. And that, right there, is the key that unlocks those much friendlier capital gains tax rates when it's sold.
But hold on, it's not as simple as just saying, hey, this one's a breeder. No way. The IRS makes you pass 2 really strict tests. You have to prove your primary intent, and you have to meet a specific statutory holding period. These 2 things are the absolute bedrock of making this classification stick.
Intent isn't just a thought in your head, it's a legal standard. As the Treasury regulation itself says, it all depends upon all of the facts and circumstances. And you know what the most important factor is? The animal's actual use. Now, let's say a heifer you intended for breeding has to be sold early because of a drought. The regs can actually allow for that. But you have to remember, the burden of proof is always on the taxpayer. And that means meticulous records.
The second test, it's a crystal clear, bright line rule. Under IRC Section 1231, for cattle and horses, the holding period is an absolute 24 months or more from the day you acquired them. Let me be clear. You sell a breeding cow at 23 months and 29 days, and any profit is ordinary income, period. Wait just a couple more days to cross that 24-month line, and it can qualify for that sweet Section 1231 gain.
Now, for other types of livestock, the rule is a little different. The code sets the bar at 12 months or more. This applies to your sheep, goats, hogs, and so on, as long as they're held for one of those qualifying business purposes. Knowing these exact timelines is just essential for any kind of tax planning.
And believe it or not, the law is super specific about what it even considers livestock for these purposes. The definition includes what you'd expect: cattle, hogs, horses, sheep, goats, and even fur-bearing animals. But it explicitly kicks out all poultry, chickens, turkeys, you name it, and also fish, frogs, and reptiles. If it's not on that includes list, Section 1231 treatment is completely off the table.
All right, so let's say your animal qualifies. You've established intent, you've met the holding period, now you've hit another fork in the road. And this one is all about the accounting. Do you treat the animal as inventory, or do you treat it as a depreciable asset? Each path takes you down a very different road with really different tax outcomes.
This table, right here, lays out the 2 worlds perfectly. On one side, you have market livestock. That's inventory under Section 471. It gets reported on Schedule F, it's taxed as ordinary income, and it gets hammered with self-employment tax. On the other side, you have Section 1231 livestock. Those are assets reported on Form 4797. The whole point there is to get capital gain treatment, which, remember, is not subject to SE tax. This chart is basically the entire ballgame in a nutshell.
Now, for farmers who use an inventory method, the Unit Livestock Price, or ULP method, is a pretty common choice. It makes the bookkeeping easier by letting you assign standard costs, but there is a massive catch, and it was settled by the Supreme Court. If you choose ULP, you have to use it for all of your raised livestock, both the ones for sale and the ones for breeding. You can't just pick and choose. It's an all-or-nothing deal.
So what about the other path? If you choose to depreciate animals you've purchased, you can't just start writing them off on day one. Depreciation can only start when the asset is placed in service. And for livestock, the IRS says this means when the animal reaches maturity, basically when it's old enough to be worked, milked, or bred.
Okay, so once you can start depreciating, you have to follow the schedule laid out by the Modified Accelerated Cost Recovery System, or MACRS. And different animals are on different schedules. For example, under the standard system, breeding hogs are 3-year property, while breeding cattle are 5-year property. These exact periods, which you find on Form 4562, are what you use to calculate your depreciation deduction each year.
All right, so eventually that animal's productive life comes to an end, and it gets sold. This is the disposition phase. And this brings us to Form 4797, Sales of Business Property. This is where everything we've talked about comes together, but it introduces one final, really complex twist: recapture. To understand the sale, you have to nail the concept of basis. And for raised versus purchased animals, it's like night and day. A raised breeding animal, it usually has a 0 basis. Why? Because you already deducted all the costs of raising it each year as an expense. That means the entire sale price is gain. A purchased animal, on the other hand, starts with a cost basis, which you then reduce over time by claiming depreciation.
And this is exactly where Section 1245 rears its head. Look, the IRS gave you a nice benefit with depreciation, an ordinary income deduction. They are not going to let you just turn around and treat the entire gain from that same asset as a lower taxed capital gain. It doesn't work that way. Section 1245 recaptures those depreciation deductions you took, forcing you to report gain as ordinary income up to the amount of depreciation you claimed.
So for purchased livestock, this creates a simple 3-step waterfall on Form 4797. First, you calculate your total gain, sale price minus your adjusted basis. Easy enough? Second, you have to fill up the ordinary income bucket with any gain that's considered depreciation recapture. And third, if there's any gain left over after all that, that's what can finally be treated as a Section 1231 capital gain.
So that was a lot of technical stuff. Let's pull all these threads together. What are the absolute, non-negotiable points you have to remember to stay compliant and, frankly, to survive an audit?
Here are the 5 big ones from our investigation. First, the tax basis is completely different for raised versus purchased animals. Second, depreciation is great, but that benefit gets clawed back as ordinary income through depreciation recapture on the sale. Third, the holding periods are not a suggestion, they are absolute. There's no wiggle room. Fourth, documentation is your only defense. You have to prove your intent. And finally, number 5, your accounting method is binding. You can't just flip-flop without getting the IRS's permission.
And that really brings us to the final, most critical question. The rules are complex, yeah, but at the end of the day, it all hinges on one thing: proof. In a forensic audit of a tax return, the records are the only evidence that matters. So ask yourself this: is the documentation you or your client are relying on strong enough to defend that all-important intent? That's the question you have to be able to answer.